We'll get started on chapter 15 today, financial statement analysis. Uh, this is the final chapter, and throughout this semester, we've gone through a lot of these ratios, but there will be a few new ones today. And essentially, we've gone through all the creation of all the financial statements, all the transactions that a company would have for the purposes of this class, right? And now we have to know, accounting, there's a couple different parts to it, right? There's the mechanical portion, so to speak, doing a journal entry, analyzing a transaction, and then there's the financial reporting component, which is creating the financial statements, right? Creating the statement of cash flows, income statement, balance sheet. Then there's actually analyzing the financial statements and figuring out, like, what does it mean? Is this a good company as a business? And that's more the finance portion and the analytical portion. And then, of course, there's audit and tax and things like that, but that's sort of beyond this course. But today we'll be going over how to look at a company and make either support the decision making of really the financial statement users, because this is financial accounting. It's meant to help external stakeholders, which is investors, mainly investors, both bondholders and equity holders, and possibly the government if they're looking at it. And it provides insights into the company's financial condition and performance, its solvency, its liquidity, its profitability, and potential for growth in the future, and also potential cash needs in the future, which is really important for investors, because if they're going to need to put up more cash in the future to keep the business going, that's something that they need to know up front. And so they're distributed, general purpose financial statements are distributed to a wide variety of users, and they provide the group with a lot of financial information on the liquidity, which is assets compared to liabilities. How are they able to meet their long-term obligations, and how much of their assets can be converted into cash quickly enough to pay their debts? Solvency is more short-term liquidity. So liquidity is a long-term view. Solvency is a short-term view. It's like, can they pay their debts this year? Liquidity is, can they pay their debts next year? Are they going to need to raise more cash next year? And then profitability is how much money is this business making? And then what's missing here is efficiency. Efficiency is also a key, which is like return on assets, inventory turnover, accounts payable turnover, and things like that. And what that really looks at is how efficiently are they managing their working capital, and also the long-term capital and assets of the business. Because a company could be extremely profitable, super high profit margins, but if their return on assets is like 2% and the return on equity is only 5%, that's not a business that's going to grow very fast. And it's not going to provide a lot of return to shareholders efficiently for the capital, right? Investors want a high return on investment, and usually return on investment and return, like, growth comes from return on equity. Because if a company's making a 15% return on equity, unless they're paying that all out in dividends next year, their equity is going to grow a lot. And the balance sheet will slowly shift from liabilities will shrink and equity will grow, and the company generally will grow. They'll invest that back into the business, or they'll pay it out to shareholders, and then the shareholders can buy more shares, right? So that's where a lot of the growth comes from, is return on equity. So liquidity, again, ability to convert assets to cash. Long-term creditors, especially bondholders, are interested in this. Solvency is, can they make their payments? So you can think of, like, liquidity. A company could be perfectly liquid and also paycheck to paycheck, so to speak. But solvency is, are all the bills getting paid on time? And short term within the year, do they have enough money to pay all the bills that are going to come due? Liquidity is more long term. And then profitability is ability to generate earnings. And we have some analytical methods that show changes in the amount of percentage of financial statement items. So we can take a look at how has this changed year over year, and then we can also take a look at ratios that take a look at that can be informative even as a single point in time. Maybe not comparing year to year, but we can know, hey, is their current ratio, which is current assets compared to current liabilities, is that greater than 1? That means current assets are greater. That gives us like a point in time window. Analytical methods, we could take a look at, their net income in 1 year and compare it year over year to the next year, percentage increase, percentage decrease. And that's going to be a lot of the homework this week, is taking a look at financial statements and computing the amount change and the percent change for every single line item, and then computing a number of ratios. And so there's two general comparisons that we do when comparing financial statements. And this is a lot of the stuff we've done sort of at the end of class, looking up 10Ks. And it's comparisons over time and comparisons among companies. So is this company growing? Is this company shrinking? Are they taking on more debt? Are they paying back debt? And then comparisons among companies. Which company has a higher profit margin? Which company has more debt, less debt? And which companies are growing? Which companies are shrinking? It can be really paint a picture of completely different strategies among the same industries. Companies can take a completely different financial approach to how they're running their business. And there's a variety of analytical methods, which is horizontal analysis, vertical analysis, and common size financial statements. And we'll just get into what that all means. And horizontal analysis is over time. So we just take a look at the same companies, same financial statements, and then over time, how much did it increase, and then what was the percentage of the increase or decrease? And sometimes this is done with only 2 years and comparing, and sometimes it can be done with 3 or 4 years too. Could also be done using past 3 years and then taking the average of the past 3 years, comparing it to this year. There's many ways to do it. I would say, and this is also extremely commonly done in auditing, to see what accounts, what financial statement line items changed, what's interesting, what should the auditors actually be looking at. For example, if long-term debt increased by 50% in the last year, the auditors would need to do some additional testing over long-term debt, or at least a risk assessment and a lot of paperwork and documentation to say, this is why we see this, we're looking at it, and this is why we're not doing any more work because of it. But they have to at least consider it and document that consideration. And then, right, investors would also like to know that long-term debt increased a lot. And what does that mean for the long-term increasing long-term debt in the short term is generally great for solvency, because it means they have a lot of cash right now. They issued a whole bunch of debt. They have a lot of cash right now, and they can pay their short-term obligations a lot better. But what does that mean for the long-term cash needs for the business and additional investment that might be needed? And so, for example, in this case here, we had long-term, and it's always really important to take note of which year is in which column, because that's not standard. So in this case, 2025 is in this column, 2026 is in the left. Now it could be reversed. It really depends on what company you're looking at. I've had it personally messed up all the time. So it's very important to know which year is the first and the second year. And then 2020, so it looks like current assets grew by 3%, but long-term investments fell by 46%, right? So that would be a key thing to look at as an investor, as an auditor, as someone on the board or something or as a banker. Look through the rest of the financial statements, look through the notes, go to the long-term investments notes to the financial statement and figure out why. What did they sell? Why are they selling it? Did they sell their long-term investments because they needed the cash? Right? Because look at what else went down. Long-term liabilities went down by 50%, by like $100,000, 50%. And property, plant, and equipment went down by $25,000. This raises the question, right? Did the company sell off their long-term investments in property, plant, and equipment to pay off $100,000 in debt? So it would all be something that we'd have to look at the footnotes for all of these accounts because each financial statement line item is going to have its own footnote that says why did the balances change? Property, plant, and equipment is usually going to break out exactly what types, land, buildings, cars, and it's also for like fixed land assets and real estate. It's actually going to list out what state each of them are from. It's really interesting. Um, and it's horizontal analysis really it points you to where you should be investigating further. That's the main purpose of it. And then this is just a comparison of the current assets. Um, and note there's not a whole lot of change here. Also, for calculation purposes, really important to note, the first year, so 2025 in this case, is the base year. So to calculate the 25% increase in temporary investments, we take 2026 minus 2025, and we get $15,000. And then we take 15,000 divided by 60,000, and we get the 25% increase. So that's how the calculation is done here. And sorry for the size of this. But we can do this with the income statement as well. So in 2025, sales were 1.2 million, 2026, 1.5 million. So that's a 25% increase. Cost of goods sold increased from 820,000 to 1.04 million. So that's a 27% increase. And so sales increased a lot, but cost of goods sold increased even more than sales. And that's part of, I don't know if you guys have taken macro or micro with Jane, but she talks a lot about, right, there's economies of scale, but then sometimes when companies get really big, costs increase even more, right? So that could be something like this. Maybe they're growing a lot, but they're growing inefficiently. Their costs are increasing even more than their sales are. And so, yes, their gross profit increased by 19% on a sort of a nominal, their gross profit increased nominally by $75,000 and 19.7% year over year, but their gross profit margin decreased. And I couldn't tell you the exact gross profit margin off the top of my head. It's not on the slide here, right? But because sales increased as less than cost of goods sold as a percentage, that means that their gross margins decreased as a percentage. So, and we can see all these other expenses. Again, it's something, it brings up a lot of questions that need to be asked. And it's really interesting if you're looking at a company listen to their earnings transcripts. And then they have, after the CEO and the CFO, they read their scripts. After that, investors get to ask questions. And if you dial in, you can ask a question. I think they screen them. I'm not sure actually, but um, usually nobody dials in. And so you can generally get to the front of the line fairly quickly, especially with a small company. And they'll ask about, okay, well, why did cost of goods sold increase more than sales? And they'll give some excuse about inflation, right? But that's what they're gonna, this is the, it drives what questions investors are asking. Um, what else? Also, what's really interesting on earnings calls is they will give guidance for what they think is going to happen in the future. And sometimes that guidance drives the stock movements more than the actual earnings per share results that get released. So, for example, um, we looked at Vail Resorts last week. They had their year-end earnings call a couple months ago. The CEO says, hey, we think that this is how much earnings per share we're going to make in 2026, or they'll provide a range. And depending on what that range is, and if that range is in line with investor expectations, that impacts the stock price a lot because it's the future growth potential. And it impacts growth stocks a lot more because growth stocks, right, their valuation is much more dependent on the financial growth of the company, whereas value stocks are more dependent on current earnings, if that makes sense. Um, that's sort of how to look at it, right? Because if we're taking a look at earnings over time, value stocks, generally the earnings are more focused in the present and in the near term and not expected to grow as much. But growth stocks, right, we're discounting all those future earnings back to the present. And so the larger part of the valuation is in the future. Um, and then we can also take a look at the retained earnings. Looks like dividends increased 33% year over year, or no, dividends increased 33% over year, which is really um, key to know. But then net income also increased 20%, retained earnings 37%. So can take a look at um, this as an indicator too. And if dividends are increasing by 33%, generally that's a sign that a company is confident that they will be able to continue paying the dividends because generally dividends stay the same a lot. And a dividend is seen sort of as a promise to investors that they will continue to be this profitable, that they'll continue to be able to make that particular dividend amount. And companies really care about this. There's a group of stocks called dividend aristocrats. That means that they've maintained or increased the annual dividend per share every single year for at least 25 years. And once companies are on that list, right, that means they're sort of a more stable company, that the dividend's probably not going to decrease in the future. And they really do their best to stay on that list, keep that reputation. Because if a company has maintained or increased a dividend for 25 years and then cuts it, then a whole bunch of people question, okay, well, what's the future of the company? Are you guys going to stop making money? Like, what's going on? And then that's why a lot of times companies won't increase dividends very quickly. You know, if their net income goes up by 20% in a year, maybe they won't increase dividends by 30% in the same year because they want to they want to make the dividend increases sustainable. They want to be able to continue to ride that high, so to speak, of increasing the dividends every single year. So vertical analysis, which we went over in the first week or two of class, is taking a look at the financial statements within themselves within a single year. So the income statement everything is taken as a percentage of sales, and the balance sheet, everything is taken as a percentage of net assets, of total assets, I should say. And then that's how we can use that to compare items like between companies of different sizes. So for example, total assets is 1.1 million. And so current assets are 48%, long-term assets are 8.3%. And this allows us to compare between companies, two particular companies or industry averages. Um, and it can highlight, once again, areas to look at it further or start building a narrative. What makes this company different than other companies? And then on the income statement, everything is taken as a percentage of sales. And then that also is what gives us our gross. So gross profit's 455,000, but the gross profit margin is 30%. And then the net income is 91,000, but the um, profit margin is 6.1%. So gross profit gives us our gross profit margin. That's the sales less cost of goods sold amount. That's like on Shark Tank when they ask them, okay, what do you sell it for, and what does it cost you? And then the difference there is the gross margin, and then as a percentage, it's the gross margin percentage or gross profit margin or something like that. And then the net income is after taxes and all the other expenses. What's their profit margin? And then in common size financial statements, it's just vertical analysis, but between different companies. And so we can take a and we can even take away the actual dollar signs if we would like, because we're looking at different companies and we're only looking at them as a percentage. So we can see Madison Corporation has a higher profit margin. Their profit margin is 9%, whereas Lincoln is 6%. And then operating income also provides us what's called an operating margin. And so that does not include other revenue, other expense, or income taxes. And it really focuses on the operations of the business. And that would, if we're using that to judge someone, right, that would be the chief operating officer would likely be judged on operating income and operating margins because that's what they can control. That's what they're responsible for. That's how they should be motivated and judged, right? Um, which of the following is not considered an analytical method to analyze the financial statements? D, correct. Um, and an analyst consensus, especially on earnings per share or what sales is going to be, what net income is going to be, that could be based on a lot of analysis and analytical methods, but that's not a method in itself. That's more of a result for what it's an opinion and it's still a result of a lot of this financial analysis. It's not actually a method to perform it. It could be a method using analyst consensuses as a data point, could be a method to value a company, but it's not actually a method. Um, so now we'll go into liquidity method, which is the ability of a company to convert current assets to cash, and banks and short-term creditors rely heavily on liquidity analysis because they're interested in a company's ability to repay loans and short-term notes. And talk about my living nightmare for the past week at work. Different time credit ratings are actually provided at much different points in time. So most companies have what's called a short-term credit rating, which is for like commercial paper. Commercial paper is when a company lends money overnight. Then they have another credit rating for short-term instruments that's usually within a year. They have another credit rating for within 3 years. And then there's also long-term credit ratings for a company. So investors are looking at all of these financial ratios and they're determining how liquid is this company within the next 3 months, how liquid is it over the next 10 years, right? And if they think a company is really liquid right now, they could be very willing to lend overnight commercial paper and then charge a much higher interest rate for a 10-year bond to the same issuer, which a company that issues a bond or issues commercial paper, that they're called the issuer. Same issuer could have much different credit rating, much different interest rate based on the length of time that the loan is for. Particularly lines of credit, even to companies with really not that stable finances, can be really low, like 6% line of credit, when if they actually issued a 10-year bond, it would be something like 9%, because they know that they have the working capital to pay back a short-term loan, but maybe long-term it wouldn't be as good. So it's really important to, like, everything that we're doing in this chapter is about building a narrative on the company. Are they able to pay short term? Are they able to pay long term? There's so much intricacies and there's so much details in finance, and accounting is what gives us the knowledge and the skill to actually be able to analyze companies and know what all this means for what's the story. Should we invest in this company? Should we lend to this company? Should we lend them money short term, long term? And then if we're in the finance department of one of these companies, what kind of financing should we try to get? Should we try and get a bunch of long-term debt so that our short-term finances are good? Or should we load up on short-term debt, but the future is uncertain? So there's a lot of decision-making that comes from the narratives that we're building, and we have to look at this information because it gives us all the info, like it tells us key facts that inform the decisions of managers and stakeholders. So current position analysis, we have working capital, current ratio, quick ratio. Working capital is current assets minus current liabilities, and that's a nominal amount. So if current assets are $1 billion, current liabilities are 500 million, working capital is 500 million. Current ratio is current assets divided by current liabilities. And so then the current ratio of that company would be 2, because current assets are twice as much as current liabilities. Quick ratio is the same as current ratio, but inventory is not included as a current asset because it has to be sold to be converted to cash, and then that involves selling expenses. And if a company is really going out of business, going out of business sale, all those kinds of things, they're not going to be able to liquidate the inventory, maybe even for what it costs to make. And it's recorded at cost on the balance sheet. So quick ratio can be very short term, like emergency liquidity ratio or solvency, really more of a solvency ratio. And then accounts receivable analysis, these is how many times is it turned over, and then days sales and receivables, and then inventory turnover, days sales and inventory. This is how efficiently are they collecting their accounts and how efficiently are they selling their inventory. And for a manufacturing inventory, it would could also be used to analyze maybe some supply chain resiliency metrics, because if they're using a bunch of just-in-time methods for managing their inventory, the days sales and inventory are going to be super low for a manufacturing company. They're getting the inventory, they're building the thing, they're shipping it out. But that means that if COVID happens or some other really bad thing that disrupts supply chains, or COVID or tariffs or whatever the next big thing that none of us know what it is, then they're not going to have that big of a stockpile in their inventory. Um, so we'll go over some more of these. And also, I did post a list of all the formulas in this chapter in a Word doc in the PowerPoint section of D2L for this week. So you guys can take a look at that. So you get just in one spot, you get all the formulas for studying and things like that. Current position analysis, working capital, current ratio, quick ratio. It helps short-term creditors within a year, right? Current assets are all within 1 year. So short-term creditors would be within 1 year. How likely are these creditors to be repaid? And so working capital is a nominal amount, and it's the ability of a company to pay its current liabilities. And it's also for as you guys take like more advanced finance courses, working capital is also used to determine a company's capital requirements because working capital is a startup cost to a business. They need to have this in order to functionally operate. Like this isn't if a company has $300,000 of working capital, that's not really optional. If it was optional, they wouldn't have it. They would borrow the money, they wouldn't invest it. It's a cost to equity holders because that's money that hasn't been paid out in dividends. And we want our dividends now, right? It's my money and I want it now. That's all investors are really thinking about. But of course, a company has to be liquid and solvent, right? So money is kept in the business to pay its current liabilities. And we can use that to compute the current ratio. So again, 2.6 compared to 2.2. The company is more liquid now than it was last year. It also has more working capital now than it did last year, which also means that because when we did statement of cash flows last week, we computed the change in current assets and current liabilities. This change in working capital from 290,000 to 340,000 decreased operating cash flows by $50,000. Because working capital increased by $50,000, cash flows from operations decreased. That means less dividends for investors. Maybe the company's clearly growing. Current assets also grew, but that's something to consider, right, when running a business is, did working capital actually need to increase that much? And quick ratio, again, it doesn't include inventory or prepaid expenses. It's only cash, temporary investments, and accounts receivable. It's something that a company could collect soon, really soon, and without costs to liquidate, right? Because inventory, when they sell inventory, there's going to be selling expenses and it's going to go to cost of goods sold. When they use up prepaid expenses, that's going to go right to expense accounts, right? Like you can't sell, if you prepay your rent, that's not an asset that you can sell off to some other company. So that stuff is not included. It only includes quick assets, which is cash and other current assets easily converted to cash, temporary investments, receivables, not inventory, not prepaids. And there are plenty of companies. The reason why those are not included, that can't really be sold off to banks or other financial institutions. But cash, temporary investments, accounts receivable, a bank would eat that up. Like you can, I don't think we got into factoring this in this course, but factoring is when a company sells off its accounts receivables and to get their cash now. And that is accounts receivable are very commonly sold things, or also think about selling items to collections. Oh, that account was sold off to collections. Well, companies can sell off accounts that are not in collections. They just sell off the accounts, and then when the customers pay, even if they're paying on time, it just goes to the company that bought it. A collections company doesn't have to buy bills that are in default. They could buy perfectly good bills from people who pay on time too. So that's the reason why quick assets is computed this way. And right, the quick ratio is much lower than the current ratio because it doesn't include inventory. And that's such a huge metric here, right? Current ratio is 2.6 for each of these, but excluding inventory and prepaids, it's 1.3 and 0.8. So if this company went bankrupt today, it would be possible that they're unable to pay their short-term liabilities. Like they will, well, and in fact, we know that unless they're able to sell this inventory, they will not be able to pay their current liabilities in time. And they have a lot of inventory, so they're probably going to be able to sell it to cover at least that amount. But it tells us something like they have to continue to sell in order to survive for a year. Um, and then a company's ability to collect its accounts receivable is called accounts receivable analysis. Oh, just another note on quick ratio and current ratio. It's especially relevant to startups and like think biotech startups, tech startups, pharmaceutical companies that don't have any revenue yet, because it determines how soon are they going to need more money from investors. And like pharma startups, they're constantly issuing new shares basically every year to fund their operations. And, it's kind of a meme to invest in pharma penny stocks, right? Because they could blow up. They could go 1,000 times or they could go bankrupt. And they're either going to go to 100 or 1,000 or they're going to go bankrupt. And every year before they get that FDA approval on some crazy new drug, they're going to need more cash from investors. And this determines when they're going to need that cash because they're not selling anything, right? So now we'll go over, this is a review of accounts receivable turnover. And we went over this in the accounts receivable chapter, but we take sales divided by average accounts receivable, and we get the accounts receivable turnover ratio. And it basically is times account, like it's the times amount of times AR is cycled through in a year. So if sales were 100 and AR throughout the year was 10, accounts receivable ratio or accounts receivable turnover, the accounts receivable turnover would be 10 because 10 times during the year AR got turned over. And if it was 12, so once again, right, a higher number is better for accounts receivable turnover because that means the accounts are being collected quicker. They have a lower accounts receivable balance compared to the amount of sales that they have. And the days sales and receivables is really just a different way to look at it. And it's average daily sales is sales divided by 365, and then days sales and receivable. This is sort of hilarious. I don't know how this got sort of corrupted like this, but it's average accounts receivable divided by average daily sales. And you can also take it as accounts receivable 365 divided by the accounts receivable turnover. Because if a company's accounts receivable turnover is 12, it's turning over 12 times a year. That's about every 30 days. So if we took 365 divided by 12, it'd be about once a month or every 30 days. So that's how to think about this. This is the basically also the average collection time of receivables. Really important metric for auditing because it determines, are they collecting the accounts receivables correctly? And if it spikes in one year and they generally are collecting accounts receivables correctly, it could also indicate that they're doing what's called channel stuffing. And what channel stuffing is if it's a December 31st company, last week of December, They're shipping out a ton of stuff to customers that they didn't order. They're booking a sale and an accounts receivable inventory cost of goods sold entry, but it's fraud, right? Because the customer didn't order it, and come the first week of January, they're just going to return it because they didn't order it, and then they'll reverse the sale in January. But that's actually a fairly common fraud and a huge risk that auditors almost always check for, especially in a retailing or a wholesaling business. And this is a very common metric to, I guess, look at that from a risk perspective. So, uh, inventory analysis. This is how efficiently is a company using their inventory. Same format as before. Cost of goods sold divided by average inventory is the inventory turnover ratio. And um, days sales and inventory would be it would be 365 divided by the turnover ratio, um, or average inventory divided by average daily cost of goods sold. So this company has 3.8 compared to 2.8. Um, Inventory turnover ratio is slowing, and that's also because their sales increased. No, their inventory tire is better, right? Their inventory turnover ratio increased because their inventory decreased and their sales increased. So they're making more sales with less inventory. That's more efficient. If they can, that's another note on working capital. If they're effectively able to decrease their inventory every year, so first year it was beginning of year 2025. So 2024, it was 311. 2025, it's 283. 2026, it's 264. They're effectively decreasing it by about 30,000 every year. Every year in the past 2 years, they've had 20,000 in operating cash flows just from decreasing their inventory. And is it accounting shenanigans? Is it operating shenanigans that they're pulling to do this, or are they really being able to be a more efficient business? Generally, they're actually being more efficient. It's pretty hard to do this as a fraud. That's why the statement of cash flows is so valuable, because inventory, especially, is a real asset. And auditors are also, if it's a material inventory balance, auditors are required to physically count the inventory at the end of the year as well. So that's a fun thing that you guys can do. If you work in audit, you can go visit a lot of really cool um, places. I funnest ones I think I've been to were counting large amounts of grain, like 10 million bushels or more of grain in huge silos. Um, Last year I visited a platinum vault and got to weigh the platinum. That was that was really cool. You can't do that without heist scenes going through your brain. I will like it's not possible. So, um, but yeah, that security level was crazy. I've also done, biomedical plastics. Um, in one single row of a warehouse, there were over 1 million muffin containers, like 4-pack plastic muffin containers, over 1 million of them in one row. And so we had to open the box, count a small number of them, and then extrapolate based on the row. Like we counted up all the boxes, but we were not counting all 1 million of them. Um, like it's cool. It gets you in tune with like what the business is actually doing. But then this allows us to analyze from a financial perspective, how effectively are they managing their operations, and how does that impact working capital? How does that impact operating cash flow? How does that impact their capital needs throughout the next couple years? So which of the following does not evaluate a company's ability to pay its current liabilities? Sorry, I didn't hear that. C, perfect. Thank you. Yes, C, days sales and inventory. That's not a liquidity ratio. It's more of an efficiency ratio on how efficiently are they using their working capital. And then my personal favorite is the cash conversion cycle. And this adds days sales and payables, which is the same as days sales and payables. It's computed as cost of goods sold divided by average accounts payable. And this shows how many days does it take from when a company pays for its inventory to when a company collects cash from customers. And it's effectively is like how much, like if we think of like it can also be called like a cash to cash cycle or a cash to cash ratio. It's, in my opinion, not talked about enough. I looked at the slides and this was not initially in the chapter, but this is such an important ratio, and it shows where is the cash being held up in the operating cycle. And companies that manage this really effectively can actually have a negative cash to cash conversion cycle. If you think about, and the biggest example of that is drop shipping, which is basically having an online store, customers pay upfront for inventory, and then you order it from China, right? And then maybe you paid China 30 days later, and then your cash conversion cycle is like negative 30 days because you never had any inventory on hand. The customer's prepaid, and um, but normally, right, a company pays for inventory and they're usually paying within 15 to 20 days. So that's generally like about 15 to 30 days is days sales and payable. Days sales and receivables, generally 30 days if it's a wholesaling company. And then days sales and inventory, we saw the last couple slides, it's like 90 days. And so that means that they have to wait almost 90 days from when they're paying for the inventory to when they're actually collecting cash from customers. And that's a huge cost to a business. Holding money ain't free, right? So Amazon has a negative cash conversion cycle. So their days inventory outstanding is 30 days, days sales outstanding is 31 days, days payables outstanding is 84 days. They wait on average 84 days to actually pay their vendors for inventory purchases. And that's because and Walmart is another example that generally is pretty close to being a negative cash conversion cycle, and it's because they're selling inventory really fast. They're collecting from customers pretty fast because, I mean, Walmart, Amazon, right? Everybody pays right when they buy the product. I don't know why their days sales outstanding is 31 days. Maybe the credit card companies are holding out in some cases. Maybe they have business accounts in some cases. But Amazon and Walmart and Costco, these huge retailers, there's such a gateway to customers that they can use that leverage and wait 84 days to pay their vendors. Because, so like, if any of you happen to be the controller, a financial controller of a company, or working in the accounts payable or accounts receivable department, a great way to figure out when do you actually need to pay. You want to stretch out the payments as much as you can without actually impacting the operations of the business. So the best, and like, right, company might say, send an invoice, no discount, net 30. So you have 30 days to pay. You might think, oh, maybe I should always pay on the 30th day. Sometimes that doesn't go over too well, even though you technically can. That doesn't mean you should. They might get angry. They might be like, why are you paying us this way? So what you do is you got all the invoices from this particular vendor. You take one of them and you wait until the 30th day and see if anything happens. And generally if you're usually paying on like day 10, day 15, usually by day 19, you'll get a letter, hey, why isn't this being paid? Then next month you pay on day 18 for one of those invoices. And you just keep doing that until you figure out how late can I pay without the vendor caring, right? And Amazon and Walmart take it to a next level where they say, I don't care whether you care, you're going to sell on Amazon, so we're going to pay you 84 days from now. But one, like, don't leave days and cash conversion cycle on the table. Every single one of these, other than inventory is its own thing, but days sales outstanding and days payables outstanding, one company's loss is another company's gain. If we look at the vendors of Amazon, their days sales outstanding is 84 days. If we look at the customers of Amazon, their days payables outstanding is 31 days, right? And so if Amazon increased its day or like decreased its sales, like right, these two are a zero-sum game, and then inventory is more of an operational, how little inventory can they hold for how much are they selling. So that's my personal rant on the cash conversion cycle. Because I think it's just super important. It's like actually how can the and this days payable and days sales outstanding, that's like how the accounting department directly contributes to operational efficiency of the company. And then inventory would be more ordering, purchasing, warehouse operations. Does anybody have any questions on these efficiency ratios, working capital, anything that we've gone over so far? Right. So analyzing solvency. Solvency is ability to pay its long-term debts. So bondholders and other long-term creditors use solvency analysis to evaluate ability to pay the face amount of the debt and make periodic interest payments. So that was a little gaffe at the beginning for me. Liquidity is short-term, solvency is long-term. So just if you make a note of that, liquidity, short-term, we went over all the working capital and stuff, and then solvency is long-term. Do they have crazy long-term debt payments, right? If we remember the bond payments, they make coupon payments every year, but then at the maturity date, the whole face value, it has to be paid. Solvency would be 5 years from now, they owe $1 billion on all their bonds. Are they going to be able to refinance properly? So we take a ratio of fixed assets to long-term liabilities, liabilities to stockholders' equity, and times interest earned ratio. Fixed assets are often pledged as security for long-term notes and bonds, particularly in like a real estate investment trust or other companies that are having large mortgages to purchase big fixed assets. And they provide a measure of, or airlines. Airlines also, a lot of times the airplanes or the gates are pledged as collateral for the loans. And they provide a measure of how much fixed assets a company has to support long-term debt. And this is really a long-term view of way out in the future, if this company goes under, how much is the collateral compared to the long-term liabilities? Because oftentimes the long-term liabilities will be more than fixed assets. But in this case, it's not. In this case, they have, these two companies are extremely solvent because their fixed assets are, 4.4 times or 2.4 times greater than the long-term liability. So if they went under, the bank would seize the assets and, they probably wouldn't be happy, but they would not lose much money at all. Also important to note, if we take these examples as sort of a standalone example, so if it's a single factory that's worth $444,000 and there's a loan on it of $100,000, if the company goes bankrupt and the asset is a collateral of the loan, bank seizes it, sells the factory for $400,000, they don't get to keep $400,000. They only get to keep 100,000 and maybe whatever small amount of interest has accrued since. The other 300,000 would go back into the pool for unsecured creditors and then whatever gets left over for the equity holders of the business. Um, bankruptcy ratio, like bankruptcy priority, big topic on the CPA exam. Top the secured, unsecured, and then all the way at the bottom is equity stock shareholders. So, and then of course preferreds first, then common. Can also take a look at a ratio of liabilities to stockholders' equity and measures how much of the company is financed by debt and equity. And so we take a look at total liabilities compared to total stockholders' equity, and it could be 0.4, 0.6. These companies have much more equity than they do debt. So a ratio of 1 would be that they're equal. Greater than 1, liabilities are more. Less than 1, stockholders' equity is more. And um, it just shows it shows a lot about the capital structure of the business more than anything. Um, I think a true solvency, it is a solvency ratio, but it much more is a leverage ratio. Like how much is equity compared to liabilities, and what does that say about how much risk is the company taking, and are they able to finance it with debt? And then what does that say about how effectively they can generate returns with a low cost of capital? Because equity, right? We want the least amount of equity possible to remain solvent for a long period of time, because investing in things carries a huge opportunity cost. Because if we can have less equity and invest in something else, then we can make even more money, right? So, um, then we have times interest earned ratio. So income before tax expense plus interest expense divided by interest expense. And this is how many times has a company earned the interest? And it is a measure of how easy is it for them to make their payments. Generally, if a times interest earned ratio is high, they'll always be able to refinance their debt, maybe take on new debt, because the bank knows that they're going to be able to make the interest payments every year. And we do income before income tax because interest is tax deductible. For example, for this company, we have income before tax of 162,000, interest expense 6,000, 28.1 times interest earned. And then this one is 12 times interest earned. Both of these companies will never have an issue borrowing debt in the near future if their profitability remains this way. What this also takes a look at is like what fraction of their income is taken away by debt too. So if a company is super loaded up with debt, right, this company, 1/12 of their income is taken away by interest expense before it gets paid. So before it gets paid out to shareholders, really. Um, so James Metal Products has a long-term loan with a local bank. Which of the following solvency ratios would the bank be most interested in monitoring? And again, this is long-term. Sorry, what was A? Yes, exactly. Times interest earned. They want to know whether that interest is going to be paid. They don't care about anything else. So we're going to go over profitability ratios at the start of next class, but I just want to, I guess, prime you guys for what next class, what I want to do is an activity where we look up a bunch of companies. And so I took this from the um, the S&P 500 pivot. I did a pivot table. I took highest market cap companies of every sector in the S&P 500. And so again, these are all the sectors in the S&P 500. We have all of these different companies. And what I want to do is, I guess, like each row, like I want each of you guys to pick an industry and then um, take a look at a company and then just compute some basic ratios and then compare and see what you guys can figure out is the narrative. Like what's driving these companies over the next couple of years and what is different based on the industries. And that's also why I want to look at it, right? I want each of you to take a look at a particular company. So um, we'll just go by row now. I think you guys usually sit in the same spot. So first row, any particular interest?
Consumer staples.
Okay, great. And then second row, what do you think? They're all interesting. They're um and if does anybody have any, but we can come back. You can pass. What you energy, okay. Great. I didn't hear. I'm not sure if you said that. Sorry. Okay, how about you? Okay. Okay. Um, Tez, or which one do you guys want? Okay. And how about at the back row? Okay, great. So that'll be good. I'll post this list online, and these are the ratios. So we're gonna go over, I guess, return on equity, return on assets, dividend yield, and stuff in the next couple. But like this is the last week. It's supposed to be fun. It's also this stuff is we're built like it's a narrative. It's like what are these companies actually doing, and how does this relate to the real world investing? There's no corporate finance classes really at Anoka Ramsey. That's something you more get to in undergrad, like at a 4 year, like when getting a um, finance or accounting degree. That's when those corporate finance classes start showing up. But I think it's just so important to know, like about what companies are thinking about. And if you ever have a small business, this is what you will be thinking about if you are intentional about your working capital management, right? So, um, yeah. And for when you're looking up these 10Ks, the easiest way to go is you want to go to the investor relations page. So if you just Google the ticker and then say investor relations or 10K, you get to the investor relations page, and I'll just show you guys because I mean, I've shown you before a couple times, like random companies, but for example, we look up, you want to go to Alphabet Investor Relations, and then sometimes it will say you can go to, and for simplicity's sake, let's do the most recent 10Ks for these companies. Um, you go to SEC filings, annual, you want to select the group as annual, and you'll find the most recent 10K. And then this is the 10K for Alphabet. You can skip right to the audit report. If you search auditor Sense, their EY client, they do a lot of the big tech companies. It's Ernst& Young. And um, shortly after the audit report is when you'll get to the balance sheet, income statement, and the other financial statements. So um, it's also really interesting. You can look up, you can look up Minnesota companies, and if you're taking a look at whether to take a job at a particular big four accounting firm or smaller accounting firm, like what are their clients? And it also says the office, right? It says Ernst& Young in San Jose, California. So that's the office that is generally working on that client. Um, because one of these days, if you go into accounting and you're working in public accounting on, you will likely work for one of your clients one day, unless you continue to work in public accounting. And so it's really important to know if you're going to be intentional about your life and your career, where do you want to go, right? It's all about making a plan and having options. And I think that nothing really does provide more options as a financial career than accounting because, right, you guys understand we went through a lot of ratios today. That's what the banks are looking at. And you guys understand everything that went into creating those ratios, creating the financials, and then looking at the narrative for the companies. So thanks, everyone.